Listen to me very carefully. I am 72 years old. I have been investing since before most of you were born. I have seen market crashes. I have lived through currency crises. I have watched the smartest money in the world make moves that changed everything. And I am telling you right now that what BlackRock just did is one of the most significant capital movements I have seen in my entire career. And 99% of investors have absolutely no idea what it really means. $2.1 trillion. That is not a typo. The world's largest asset manager, controlling more money than most entire countries, just moved $2.1 trillion. And while the headlines are screaming that BlackRock is fleeing America, while YouTube is full of doomsday predictions, I am here to tell you the truth. Because I have been through enough market cycles to know the difference between fear mongering and actual information. And what is really happening is both more complex and more profitable than anything you are reading in the mainstream media. Now, before I tell you exactly what BlackRock is doing, why they are doing it, and most importantly, how you can position yourself to profit from the same trends, I need you to do something for me. If you are serious about protecting your retirement, if you want to understand how the biggest money in the world actually operates, you need to subscribe to this channel right now. Hit that button, join this community. Because what I am about to share with you is not clickbait. This is not fear mongering. This is intelligence from someone who has been in the markets for over 50 years. So subscribe and let us navigate this together. Do it now. I am Charles Wellington. And unlike the young people on television who have never lived through a real market dislocation, I remember what it looks like when the big money moves. I know how to read these signals. And I am seeing patterns right now that create massive opportunities for investors who understand what is actually happening. All right, let me start with what you have probably seen plastered all over the internet. BlackRock flees America. $2 trillion bolts out of the United States, the beginning of the end, time to bury your gold in the backyard and stock up on canned goods. Sounds terrifying, right? But here is what actually happened. And I am going to cite facts, not hysteria. BlackRock manages $14 trillion in assets as of the end of 2025. That is bigger than the entire economy of most countries. They are the largest asset manager in the world, so when they move money, people notice. Now, did they move 2.1 trillion completely out of the United States? Absolutely not. Here's what they actually did. They went underweight long duration US Treasuries. Let me break that down because this is critical. BlackRock reduced their exposure to long-term US government debt. They did not eliminate it. They just reduced the percentage of their portfolio allocated to 20-year and 30-year Treasury bonds. They still hold US debt. They are just holding less of it in the long duration maturities. Why would they do this? Because when you have $38 trillion in national debt and interest rates are doing what they are doing, holding a 20 or 30-year US bond becomes risky. Not because America is going to default tomorrow, but because the mathematics change. The risk-reward equation shifts. Think about it this way. If you had a choice between lending someone $100 for 30 years at 4% interest or lending that same person $100 for 5 years at 4.5% interest, which would you choose? Of course, you would choose the shorter duration. You get more interest and you get your money back faster because who knows what inflation is going to do in 30 years. If inflation goes to 10% and you are locked into 4%, you are losing money every single year. This is exactly what BlackRock did. They are not panicking. They are managing risk. They are being prudent, and they are doing what any intelligent investor with a long-term time horizon should do. They are reducing exposure to long-duration bonds when the risk-reward does not make sense anymore. The second thing BlackRock did is diversify more globally, and this should not be surprising to anyone who understands how professional money is managed. BlackRock stated in their outlook that they are pursuing more country dispersion. That is finance speak for spreading money across more countries rather than keeping everything concentrated in one place. So what did they do? They increased allocations to Europe, to Asia, to emerging markets like Brazil and India. They are investing heavily in AI infrastructure globally, not just in the United States, because the AI revolution is not an American phenomenon. It is a global phenomenon, and the smart money knows that. But here's the part the headlines conveniently forgot to mention. BlackRock is still heavily invested in US equities, particularly in companies related to artificial intelligence. If they were truly fleeing America, would they be overweight? US stocks? Of course not. They are being selective. They like American companies. They are just less excited about American government debt at current valuations and current interest rate levels. This is not doom. This is portfolio management. And if you understand why they are doing what they are doing, you can make smarter decisions with your own money. Now, to really understand the opportunity here, you need to understand the three massive shifts happening in global markets right now. These are not temporary trends, and these are structural changes that are going to define investing for the next decade. And I have been through enough cycles to recognize when something fundamental is changing. Shift number one, the dollar's weakening. And contrary to what most people think, this is actually a good thing if you know how to position for it. The US dollar just had its worst year since 2017. It fell 9.4%. That is a significant move for the world's reserve currency. Now, if you are going on vacation to Europe, this is bad news. Your dollars buy less. But if you are an investor who understands what a weaker dollar means, this creates massive opportunities. When the dollar weakens, here is what happens. International stocks become more valuable for US investors. American companies that export goods become more competitive globally, and commodities, which are priced in dollars, things like gold and silver, tend to rise in price. And look at what happened last year. International stocks crushed US stocks. Europe was up 23%, Spain was up 49%, South Korea was up 76%, Japan was up 26%. These are extraordinary returns that most American investors completely missed because they only look at the S&P 500. Now, I am not saying the AI revolution is not happening in America. Of course it is. Nvidia and Microsoft and all the big players are doing extremely well. But who makes the chips? Taiwan. Who makes the memory? South Korea. Who builds the infrastructure for AI data centers? Countries across Asia and Europe. The global AI boom is spreading wealth beyond Silicon Valley, and BlackRock sees this. That is why they are diversifying internationally. And here is the additional benefit. When you invest internationally and the dollar continues to weaken, you make money twice. Once from the stock going up, and once from the currency appreciation when you convert back to dollars. This is currency tailwind, and it can add significant returns to your portfolio. Shift number two, the bond market is changing in fundamental ways. The United States is adding about $6 billion a day in new debt. Every single day. They are issuing massive amounts of treasury bonds to fund the deficit. And foreign central banks, those pesky foreigners, are reducing their U.S. debt holdings. They have sold $48 billion worth since March of last year. Now, what does this mean for you? It creates opportunities, but not necessarily in government bonds. The opportunities I see are in corporate bonds. There are corporate bonds out there paying very attractive yields for relatively modest risk. Investment grade corporate debt from solid companies, shorter duration bonds that mature in 2 to 5 years instead of 20 to 30 years. BlackRock looked at the long duration treasury market and said the risk reward is not there anymore. So they took profits on positions they already owned, they locked in gains, and they are repositioning for what comes next. This is what smart investors do. They do not marry their positions. They adjust as the facts change. Shift number three, a massive global reallocation is underway, and this is the part most people do not see coming. For decades, the playbook was simple: buy American stocks, buy American bonds, hold dollars. That was the safest, most profitable strategy in the world. But that playbook is changing. Central banks around the world are diversifying away from dollar assets, not because they hate America, but because concentration risk is real risk. And when you have all your reserves in one currency, one country, you are exposed if anything goes wrong. So they are buying gold, they are buying other currencies, they are spreading their bets. This is not the end of the dollar. The dollar is not going to zero, but dollar dominance is declining. And that creates opportunities in international markets, in precious metals, in assets that benefit from this diversification trend. If you understand this shift, you can position your portfolio to profit from it over the next decade. Now, let me get to what you actually came here for. How do you profit from this? I am going to walk you through 5 specific opportunities. These are areas I am researching. These are sectors I find interesting. This is not financial advice. I am not your advisor. You need to do your own homework. but I am going to share with you exactly how I am thinking about this. Opportunity number one, international stocks. For the first time in a very long time, international stocks are cheaper and potentially more rewarding than US stocks. The S&P 500 is trading at about 20 times earnings right now. That is expensive by historical standards. International developed markets are trading at about 13 times earnings. That is a significant discount. And when you factor in that the dollar is likely to continue weakening because of all the money printing and deficit spending, this becomes even more attractive. You get the potential for stock appreciation plus currency appreciation. That is a powerful combination. Now, I am not saying dump everything and go all international. That would be foolish. But allocating 10 to 20% of your portfolio to international stocks makes sense in this environment. Europe is interesting because they are massively increasing defense spending. Germany is printing money to fund military buildup. Banks are becoming more profitable as the European Central Bank cuts rates. Japan is interesting because Warren Buffett went very long Japan last year. And when Buffett makes a move like that, I pay attention. I have been investing for 50 years and I have learned that Buffett does not make big international bets without very good reasons. South Korea is interesting for semiconductors. Samsung, SK Hynix, these companies are critical to the global AI infrastructure build-out, and they are trading at much more reasonable valuations than American chip stocks. You can invest in these markets through exchange-traded funds. There are ETFs that give you exposure to developed international markets, Europe, Australia, Japan, all in one fund. There are emerging market ETFs for more aggressive positioning. And there are single country ETFs if you want specific exposure to Japan or South Korea or other markets. I am not going to tell you specific ticker symbols because I am not trying to sell you anything. But these opportunities exist and they are worth researching if you want to diversify beyond the United States. Opportunity number two, precious metals. Gold had a monster year in 2025, and I believe it is not done yet. I have been investing long enough to know what gold does when central banks are buying. And central banks are buying like crazy right now. Why is gold rallying? Because foreign central banks are selling US debt and buying gold instead. It is a way to diversify away from dollar exposure, away from US political risk, away from debt concerns. Gold is the I do not trust anything asset. And in an environment of massive government spending and currency debasement, gold traditionally does very well. I was talking to a precious metals dealer yesterday. He told me if you order physical gold or silver now, you have to wait 4 months for delivery. 4 months. The US Mint has stopped selling silver eagles. These are signs of real physical demand. Now, I am not saying put your entire portfolio in gold. That would be crazy. But allocating 5 to 10% to precious metals as insurance makes sense, especially for someone my age who has seen what happens when currencies get debased and governments print too much money. You can buy physical gold if you want to store it yourself, or you can buy gold ETFs that track the physical gold price. There are also gold mining stocks, which are more volatile but give you leverage to the gold price. And there is silver, which tends to outperform gold in bull markets but is much choppier. I personally own both gold and silver, not as a trade, as insurance, as protection against the kind of monetary madness I have seen too many times in my life. Opportunity number three, selective US stocks. Now, just because BlackRock is moving some money around does not mean you should abandon US stocks. That would be throwing the baby out with the bathwater. The United States still has the most innovative companies in the world, the deepest capital markets, the best business environment. That has not changed. But I think you need to be selective. The S&P 500 is expensive. The Magnificent Seven tech stocks are at valuations that leave very little room for error. But there are still opportunities if you know where to look. I am looking at companies that use AI to improve their margins and grow their businesses, not just the companies making chips, the companies implementing AI to drive profitability, cloud computing providers, Amazon, Microsoft, Google. These companies have massive moats and they can pass on higher energy costs to their customers. I am looking at cybersecurity. That is a sector that keeps growing regardless of what else is happening in the economy. I am looking at dividend growth stocks for more conservative positioning. Companies that have been paying and growing dividends for decades. These are businesses that generate real cash flow and return it to shareholders. And I am looking at small caps if interest rates come down. Small companies are more sensitive to interest rates than large caps. When borrowing costs fall, small businesses benefit disproportionately, so there could be significant opportunities there if the Fed continues cutting. Opportunity number four, inflation hedges. I believe we are going to see inflation come back later this year, probably after the midterm elections. All this government spending and debt creation is going to show up somewhere. And when inflation picks up, you want to own assets that benefit from rising prices. Energy stocks traditionally do very well in inflationary environments. Oil and gas companies, utilities. These are businesses that can pass on higher costs to consumers. Financial stocks also tend to benefit when rates rise to combat inflation. Banks make more money on their lending when interest rates go up. And real estate investment trusts could have a very good year as interest rates initially come down. Rates have been beaten up by high rates for a long time. As rates fall, their borrowing costs decrease and the value of their properties increases. That is a double benefit. Opportunity number five, corporate bonds. Now, I know most people find bonds boring, and they are boring, but boring can be profitable. There are corporate bonds out there paying very attractive yields right now. Investment grade corporate debt from solid companies. 5 to 6% yields on bonds maturing in 3 to 5 years. That is real income. That is guaranteed income if the company does not default. And if you buy bonds from strong companies with good balance sheets, the default risk is very low. This is an opportunity that most retail investors are completely ignoring because they are chasing stocks. But for someone my age who wants income and capital preservation, corporate bonds are very interesting right now. Now, let me give you the reality check, because I am not going to be one of those people who pretends everything is guaranteed. There are three things you need to remember. First, do not abandon U.S. markets. This is not about dumping everything American and going all international. The United States has the biggest stock market in the world, the deepest pools of capital, the best innovation ecosystem. Where does every entrepreneur in the world want to build their company? The United States. That has not changed. So keep your core U.S. holdings. Just diversify around the edges. Second, do not put all your money into new positions in one day. Dollar cost average, spread your purchases over weeks or months. This smooths out volatility. It makes it easier psychologically to hold positions when markets get choppy, and it prevents you from buying everything at the top. Third, know your exit plan. Taking profits is not a dirty word. It is the entire point of investing. If international stocks run up significantly, take some profits. If gold doubles, take some chips off the table. Have rules, have discipline. Do not just buy and hope. I have been investing for over 50 years, and the biggest mistakes I have seen people make are emotional mistakes. They buy at tops because of greed. They sell at bottoms because of fear. They hold losing positions too long because of ego. Do not be that person. Have a plan. Follow the plan. Adjust when the facts change. Here is my action plan for you. First, look at your current portfolio allocation. What percentage is in US stocks? What percentage is in international? Do you own any precious metals, any bonds? Know where you actually stand. Second, decide where you want to be. Based on everything I have shared, does it make sense to add some international exposure, some gold and silver, some corporate bonds? Figure out your target allocation. Third, create a plan to get from where you are to where you want to be. Do not do it all at once. Spread it out over the next few months, dollar cost average into new positions. Fourth, monitor and rebalance. Check your portfolio regularly. If something runs up a lot, take some profits. If something gets beaten down, maybe add more. Stay active, stay engaged. And most importantly, keep learning. The world is changing, markets are evolving. What worked for the last 40 years might not work for the next 40 years. So stay curious, stay informed, and do not let fear or greed drive your decisions. Here is what you need to understand. BlackRock just moved $2.1 trillion. But they are not fleeing America. They are repositioning for a changing world, a world where the dollar is less dominant, where international markets are more attractive, where long duration bonds are less appealing, where global diversification makes sense. This is not doom and gloom. This is opportunity, but only if you understand what is actually happening. Only if you can separate the fear mongering from the facts. Only if you can think like the big money thinks. I am 72 years old. I have been through market crashes and currency crises and everything in between. And I am telling you that what is happening right now is not scary. It is exciting because change creates opportunity. And the investors who understand the change are the ones who profit from it. The investors who stick their heads in the sand and pretend nothing is different are the ones who get left behind. Do not be that person. Be the person who sees what BlackRock sees, who positions like the smart money positions, who profits from the trends instead of fighting them. Now, if you found value in what I just shared, I need you to do something for me. Hit that subscribe button, leave a comment below, and tell me how you are thinking about international diversification. Are you adding international stocks? Are you buying gold? Are you adjusting your bond holdings? I want to hear from you. And share this video with everyone you know who cares about their retirement because this information could save them from making terrible mistakes. The world is changing. The smart money is repositioning, and you need to understand what that means for your portfolio. I am Charles Wellington. I have been investing for over 50 years, and I am telling you that what BlackRock just did is a signal that the world is changing. Pay attention, position accordingly, and profit from the trends. Thank you for watching, and may you protect and grow your wealth in the years ahead.